C Corporation Operations Tax Basics Problem 1. Orange Inc., a C corporation for federal tax purposes, owns 82% of Citrus Corporation common stock, a C corporation for federal tax purposes. This year, Orange generated $50,000 operating income, not including dividends. It also received $10,000 of dividends from Citrus Corporation. Compute Orange's taxable income. This is a very straightforward question. It's just asking to compute Orange's taxable income. Now, one thing to note in this question, there's two separate C corporations. Orange Inc., which is a C corporation, and we have Citrus Inc., or Citrus Corporation, my apologies, Citrus Corporation, which is also a C corporation. Now, anytime that you see a problem where one corporation owns another, one specifically a C corporation owns another C corporation, and we denote C corporations by doing a little square, sometimes you'll see a rectangle, but square is correct, and O for orange. Orange owns another corporation, another C corporation. Again, C corporation is going to be a square. If it's an S corporation, that is a flow-through entity, so we don't use square for that because it's not the same as a C corporation. That would be a C with a box around it for a C corporation. C for citrus. So Orange owns Citrus. Orange owns 82% of Citrus Corporation. So Orange Inc. owns 82% of Citrus Corporation. And again, they're both C corporations. That is very important. Anytime you see a problem where one C corporation owns another, very likely the dividends received deduction, DRD, not DDR, not the game Dance Dance Revolution, but DRD, the dividends received deduction, that's going to come into play. So we abbreviate that DRD, again, not DDR, not like Dance Dance Revolution, but DRD, dividends received deduction. Anytime you see a C corporation owns another C corporation in a problem, there's probably going to be some aspect, could be other issues, but that's one thing. And we have that here. We're told that Orange, which again, we're computing Orange's taxable income, we're not computing Citrus's corporate taxable income, just Orange's. We're told that this year Orange generates $50,000 of operating income, not including any dividends received. It also received $10,000 of dividends from Citrus Corporation. So the $50,000 of operating income that we're told, that $50,000 of operating income does not include any dividends. That's from the normal operations. That's from the normal operations of the business, not including any interest, gains or losses on sales of property, or dividends. We're talking about the normal sales, normal operations of the business. If it's a retailer, the normal operations of being a retailer, selling your merchandise and the normal cost of goods sold and expenses related to that. So $50,000 operating income does not include dividend. Well, we're computing Orange's taxable income, so we're going to have to add in the dividend received. The $10,000 of dividends received from Citrus Corporation, that gets added into the operating income. So the dividend received from Citrus Corporation, dividend received. And again, the idea here is Citrus Corporation, which Orange owns 82%, Citrus Corporation is paying Orange a $10,000 dividend. And that dividend is going to go into taxable income. However, this is where the dividend received deduction comes into play. Anytime that you see a C corporation owns another C corporation, so here we have Orange Inc., which is a C corporation, told in the facts, owns another C corporation. So Orange Inc., a C corporation, owns Citrus Corporation, which is a C corporation. That's what we have here. Anytime, doesn't matter what ownership percentage, the dividend that's paid to the parent, here Orange, basically parent just means the party that is owning. The parent corporation here, any time that the dividend is paid to the shareholder that owns the other C corporation, a dividend received deduction comes into play. Now, the percentage is going to change depending on ownership. But if you own more than 80%, of the other C corporation, you're going to get a 100% dividends received deduction, 100% DRD. So if you own more than 80%, which here we're told that Orange Inc. owns 82% of Citrus. So that is greater than or equal to, I should say. Greater than or equal to 80%, I should say, I apologize. That is greater than or equal to 80%. If it's greater than or equal to, make sure you put that, I just changed it right there. 80% of the other C corporation, you receive a dividend, you get a 100% dividend receive deduction. So that means that we get to subtract away the same $10,000, which is a DRD, dividend receive deduction. So in calculating our taxable income, we're going to take the 50,000 plus the 10,000 minus 100,000. The taxable income for Orange in this problem, taxable income is going to be $50,000. The two $10,000 amounts offset. Now, if the ownership percentage was different, well, it depends on the year. The years it's changed. The ownership percentage has changed. The 80% number has stayed the same. In the past, it's been if you've owned more than 20% up or 20% to less than 79%. I'm sorry, less than 80%. My apologies. If you own from between 0 and less than 20%, you get a percentage. If you own 20% to less than 80%, you get a certain percentage. Those numbers have changed. It's been 50, 65, it's been 70, 80. It depends on the year. One thing that is clear is that if you own more than or equal to 80% of the other C corporation, you get a deduction, and you get a dividend, you get a 100% dividend receive deduction. Now again, the most important thing to take note of, this only applies when a C corporation owns another C corporation. Because the general rule is that dividends you cannot deduct dividends. Only applies when a C corporation owns another C corporation and the C corporation that's the shareholder of the other C corporation receives a dividend from the C corporation they own. And the idea is that we're trying to avoid triple, quadruple, quintuple taxation. Basically, trying to limit it to only 2 levels of tax by providing this deduction so that the other C corporation, which is going to get hit with double taxation at the entity level and then the owner level on distribution, we're trying to reduce that. So that's the idea here. So really, again, when you see 2 C corporations in a problem, you see a dividend and you're trying to determine taxable income, very likely you have dividend receive deduction like we have here. Again, the correct answer, $50,000 taxable income, which is the operating income, plus $10,000 dividend received, minus $10,000 dividend receive deduction because Orange owns greater than or equal to 80% of Citrus Corporation. Or I should say Orange Inc. owns greater than or equal to 80% of Citrus Corporation.